Welcome to Profit Protection. Today, we're examining Warren Buffett's recent actions and why they have the investment community on high alert. Buffett has been amassing a huge cash reserve, which many interpret as a sign that a market downturn could be imminent. Let's explore why Buffett's strategy is raising concerns and what steps you can take to protect yourself. Berkshire Hathaway's cash reserves have swelled to nearly $200 billion. This has prompted many to question why Buffett, one of the world's most renowned investors, is holding on to so much cash. Recently, Buffett shared that he's waiting for attractive investment opportunities, which he currently doesn't see in the market.
This question's from Johan Halen, who writes, "You're sitting on $168 billion of cash, which you told us today is now more than $182 billion. His questions are, one, what is Buffett waiting for? And two, why not at least deploy some of it?"
Well, I think that's pretty easy to answer. I don't think anybody sitting at this table has any idea of how to use it effectively, and therefore we don't use it, and we don't use it now at 5.4%, but we wouldn't use it if it was at 1%. Don't tell the Federal Reserve that, but prefer it. But we only swing at pitches we like, and if anybody tried to swing at every pitch or felt that because they hadn't swung at a pitch for the last two pitches, they ought to swing at the third one or something like that. There are times, and obviously, but I would say this, I would not like to be running 10 billion now. 10 million, I think Charlie or I could earn high returns on, because I think there's just a few things that happen on a very, very small scale. But if we had 10 billion, I wouldn't basically see many more opportunities than we found. Now, it's true that something like Japan we could have done if the company had a 30 or 40 billion, and we'd have had great returns on equity. But if I saw one of those now, I'd do it for Berkshire. It isn't like I'm got a hunger strike or something like that going on. It's just that things aren't attractive, and there's certain ways that can change, and we'll see whether they do.
Buffett is preparing for a significant market disruption that has been developing over the past 15 years. One of his preferred market indicators is signaling a potential 40% decline in the stock market. Buffett's every move is closely watched by investors worldwide, but it's his current inaction that's causing anxiety. It's what Buffett isn't doing that's making people nervous. Stick around until the end of this video to learn how you can safeguard your investments. Here's what Buffett said at the recent Berkshire Hathaway annual shareholders meeting when asked about his large cash reserves. Buffett is widely regarded as one of the greatest investors of all time, yet he has been unusually quiet about buying stocks recently. In fact, Buffett has been offloading billions of dollars worth of Apple stock, a company he once considered a long-term hold. Consequently, Berkshire Hathaway's cash pile has ballooned to $189 billion, leading many to speculate that Buffett is bracing for a market crash. Buffett explained that he doesn't mind increasing his cash reserves given the current economic conditions and market outlook. This makes one wonder if he believes the entire market is overvalued. Although Buffett has often stated that timing the market is impossible, his actions suggest a different story. While he claims not to time the market, Buffett always seems to have a substantial amount of cash ready to deploy when the market drops. Here's a look at Berkshire Hathaway's cash reserves by quarter from 1996 to 2018, alongside the S&P 500 index. The S&P 500, which consists of 500 large U.S. companies, serves as a proxy for the overall stock market. One notable period is the dot-com bubble of 1998-1999. During this time, while the S&P 500 surged, Buffett avoided investing, and Berkshire's cash reserves grew significantly. Many criticized Buffett, claiming his investment style was outdated. Buffett, who had avoided tech investments, warned the attendees about the market bubble. His caution was not well received, but he was proven right when the dot-com bubble burst, leading to massive market declines.
Anytime there have been real bursts of speculation in the market, it does get corrected eventually. Ben Graham was right when he said that in the short run it's a voting machine, in the long run it's a weighing machine. Sooner or later, The amount of cash that a business can disgorge in the future governs the value it has that the stock commands in the market, but it can take a long time. It's a very interesting proposition. For example, if you take a company, in the end never makes any money, but the trade changes hands representing a valuation of 10 or 20 billion dollars for some time, there's no wealth created. There's a tremendous amount of wealth transferred. And I think you will see, when we look back on this era, you will see this as a period of enormous amounts of wealth transfer. But in the end, the only wealth creation comes about through what the business creates. There's no magic to it. If a company that's not worth anything sells for $20 billion and 5% of it changes hands, somebody takes $1 billion from somebody else. Investors as a whole gain nothing. They all feel richer. It's a very interesting phenomenon, but they can't be richer except as a group unless the company makes them richer. And it's the same principle as a chain letter. If you're very early on a chain letter, you can make money. There's no money created by chain letters. In fact, there's the frictional cost of envelopes and postage and that sort of thing. So the net, there's some money destroyed a little bit. And there's money destroyed by the frictional costs of trading and investing. That comes out of investors' pockets. But the manias that periodically take place, and not just in stocks. We had a similar mania. I'm not necessarily similar. We certainly had a mania in farmland here in Nebraska 20 years ago. And land which couldn't produce, we'll say, more than $70 or $80 an acre would sell for $2,000 an acre at times when interest rates were 10%. Well, that math will kill you. And it killed the people who bought it at those prices, and it killed a great many banks here in Nebraska who lent based on that sort of thing. But while it was going on, everybody thought it was wonderful because every farm was selling for more than the similar farm it sold for a month earlier. And it was momentum investing in farmland. And in the end, valuation does count, but it can go on a long time. And when you get a huge number of participants playing with ever increasing sums, it creates its own apparent truth. It can be for a very considerable period of time. It doesn't go on forever. And whether it has fallout to the whole economy, like it probably did in the late 20s, or whether it's just an isolated industry or sector where the bubble bursts and it really doesn't affect other values.
Buffett's cash strategy during the dot-com bubble allowed him to capitalize on low prices when the market crashed. Buffett accumulated a substantial cash reserve during the lead-up to the great financial crisis. His cash holdings reached a record high of over $40 billion, more than double the amount he had during the dot-com bubble. As the stock market plunged by over 50%, Buffett deployed this cash to acquire valuable assets at bargain prices. Among these investments was the purchase of the railroad company BNSF for $34 billion, a business now estimated to be worth at least $150 billion, resulting in a $100 billion profit for Buffett and Berkshire Hathaway. Buffett also invested tens of billions into prominent blue-chip companies. His investments included industrial conglomerate General Electric, chemical producer Dow Chemical, and the food company Mars, which owns popular brands such as Three Musketeers, M&M's, and Snickers. Additionally, he made significant investments in financial services giants Goldman Sachs and Bank of America. His stake in Bank of America has now grown to nearly $40 billion.
When 2008 and 2009 financial panic came along, we didn't own anybody's commercial paper. We didn't have money market funds. We have treasury bills. And as I may get into a little later, I'll explain to you why. We believe in having cash. And there have been a few times in history, and will be more times in history, where if you don't have it, you don't get to play the next day. It's just it's like oxygen. It's there all the time, but if it disappears for a few minutes.
These examples demonstrate that while Buffett insists he doesn't attempt to time the market, he consistently has substantial cash reserves available when market downturns occur. The current cash pile he holds dwarfs those from previous periods, underscoring his cautious approach in the face of potential market overvaluation. Currently, Buffett's cash position is larger than ever before, signaling his anticipation of a potential market correction. His nearly $200 billion cash reserve suggests he finds few few attractive investment opportunities in today's market, indicating his belief that the market might be overvalued. Buffett's track record of accumulating cash ahead of major downturns explains why his current actions are causing concern. While he won't explicitly state that the market is overvalued, his strategy speaks volumes. Let's rewind to 2001, when Buffett was more candid about his cash strategy. He emphasized the importance of holding cash when investment opportunities are scarce, highlighting his preference for strong returns over mere deployment of capital.
With him on payday and having him decide the exchange rate on that date. But we obviously are looking every day for ways to deploy cash. And we would never have cash around just to have cash. I mean, we would never think that we should have a cash position of X percent. And frankly, I think these asset allocation things that tacticians in Wall Street put out, about 60% stocks and 30%, we think that's total nonsense. So we want to have all our money working in decent businesses, but sometimes we can't find them, or sometimes cash comes in unexpectedly, or sometimes we sell something, and we have more cash around than we would like. And more cash around than we would like means that we have 10 or 15 cents around, because we want money employed, but we'll never employ it, just employ it. And in recent years, we've tended to be cash heavy, but not because we wanted cash per se. In the mid-70s, we were scraping around for every dime we could find to buy things. We don't like lots of leverage, and we never will. We'll never borrow lots of money at Berkshire. It's just not our style. But you will find us quite unhappy over time if cash just keeps building up. And I think one way or another we'll find ways to use it.
Buffett dislikes holding large amounts of cash, but refuses to invest unless he sees favorable prices. One way to measure whether the stock market is overvalued is by using the Buffett Indicator. This metric, introduced by Warren Buffett over 20 years ago, is considered one of the best single measures of stock valuations. Understanding the Buffett Indicator can help explain why Buffett isn't buying stocks right now. The calculation for the Buffett Indicator is straightforward. It is the ratio of the total value of the U.S. stock market as measured by the Wilshire 5000 index to the U.S. economy's size as measured by gross domestic product, GDP. As of March 31st, the stock market's value was $55.84 trillion, while the GDP was $28.2 trillion. This gives us a Buffett Indicator of 197%. The critical question is how this compares to historical levels. If the stock market were only 10% or even 20% higher than normal, it might not be too concerning. However, the current Buffett Indicator is a staggering 61% above the historical trend line, which is 2 standard deviations above what is considered fairly valued. In simpler terms, this means the stock market would need to fall by 40% to be considered fairly valued at the current size of the economy. This significant overvaluation makes it clear why Buffett has been selling stocks and accumulating cash. Buffett's most recent annual letter to shareholders talked about how he manages his company, Berkshire Hathaway, to be a financial fortress capable of withstanding any financial shock that may come its way. Here's how he described it. Your company, referencing Berkshire, also holds a cash and U.S. Treasury bill position far in excess of what conventional wisdom deems necessary. Extreme fiscal conservatism is a corporate pledge we make to those who joined us in ownership of Berkshire. Berkshire is built to last. While we can't predict the future, we can follow Buffett's example. Build a cash reserve, diversify your investments, and remain patient. These strategies can help you navigate any market volatility.
Do you worry about another crisis?
Well, there'll be one sometime, but no, I don't worry about it in the least.
Because
I conduct myself so that there's another crisis, I'll still be around. Berkshire will be in good shape.
If you enjoyed this video, make sure to subscribe and hit the bell icon for more insights on protecting and growing your wealth. Thanks for watching Profit Protection. Until next time, invest wisely and stay informed.